Good evening and welcome to the FITT Show. Financial information for today and tomorrow. I'm Bobby P. Kinzer.
And I am Thomas Doty.
And we are the FITT Show, helping our people get their finances in shape. How are you doing today, Dote?
Man, another good day. Warm weather, feeling good, life's good.
You're looking absolutely marvelous, I must say there. Keep up the good looks. Matter of fact, I saw somebody look your age the other day. You better be glad you don't look your age. Keep up the good work. So, welcome to the show. We're going to be talking about information to help you build and grow your wealth. We want to talk about building wealth for your kids generationally. And we talk about all subjects from taxes to investing to budgeting. But today's show is entitled Cash is King. And with this market the way it is, the stock market taking the beating, usually cash becomes king and everybody wants to retreat to cash. But we're going to talk about that today. So before we go any further, we're going to kick off the top of the show, which we always start with. But before that, please click on the like button as many times as you can and the heart button to help give us more exposure and access to more people. That's how Facebook works. And please put comments in the comment boxes. That even works even more exponentially. And that same thing works with YouTube. So all you people out there, thank you and welcome everybody. So, Doe, let's start off with our favorite subject at the top of the show, the stock market.
It's kind of funny because for the week, the market didn't really do too bad. It had a big sell-off today. The stocks fell a bunch today. But for the week, I mean, you look, the Dow's only down 3 points. NASDAQ is up 66. Microsoft is down a couple. Tesla's down 5. And that Tesla's down 5 after a big run. Apple's actually up, and Pfizer is pretty flat. But the Dow had a big sell-off today, and it's because of the same thing. It's inflation. It's like everybody wants us to be past this, and the stock market keeps reacting to the positive news. And then some negative news will come up, and then the market takes a big drop. Like today's, the January's product price index came out, and they expected it to be only a 0.4% increase, but it was up 0.7%. And also the job claims were less than expected, which you would think would be good, but it's not, because it says that what the Fed is doing is not slowing the market down enough. And so if it's not slowing down enough, the way it slows it down is to continue to raise interest rates. And that's why the market reacted accordingly today. And so, again, things were going pretty good. The week had been going really, really good. But then just today, I mean, the Dow fell over 400 points today. I mean, it just, because of the information regarding the inflation. NASDAQ was down 300 points today. So the market had been going pretty good. But it's going to be this way for a while until the Fed feels inflation's under control. It's just a matter of how bad things will get before they are comfortable that they've slowed the market down enough to put inflation under wraps. So as we always say, just hang in, don't panic. Things are going to continue to be shaky for a while. And this is a good time to look for opportunities. Look for real good stocks that are taking a beating, and might be a good time to buy.
So, like we always say, it's all about the long play, and it's also about having a financial plan and a portfolio mix that can withstand, whether the market's going up or going down, or future shocks from the economy. So that's one of the things why we're going to have this show today, because when usually the stock market starts going down, everybody wants to retreat to cash. And usually when the Federal Reserve start increasing those interest rates, the interest rates on those savings accounts seems to start going up too. So we're going to have that discussion. But before we get into that discussion, let's talk about the cryptocurrency market, dope. Now, a lot of people was poo-pooing the cryptocurrency market because about a month ago, for the year, it was down over 70%. But something's going on, dope. It's starting to take a turn. The actually total market cap of cryptocurrency is up to $1.1 trillion now. It's up 65 billion. That's up about 6%. So people are slowly getting back into the cryptocurrency market, especially the top 10. And Bitcoin is the number one of all the cryptocurrencies, and it's selling today at, as of 7 p.m., $23,623. That's up $1,815. That's up 8%. And as I told you, the last few weeks, it's been going up around 8, 9% every week. So if you have some money in cryptocurrency, no, let me just be specific, in Bitcoins,
Yeah.
let me clarify that. Let me qualify that. That's a fact. If you would have had Bitcoins, your money would have been earning 9% a week. And that's pretty rare, though. I don't know if you can find that. But once again, that's no guarantee that it's going to continue to do that because we talk about how speculative cryptocurrency is. Ethereum, the smart contract, is still at the number 2. It's up 96 billion. No, sorry, that's
$96.
$96 because that's $1,642 per Ethereum.
Correct.
Cryptocurrency. And then the Tether has been holding that dollar because that's one of the stable coins, which is backed by the dollar in theory. Dogecoin and Shiba just been really holding. They ain't been going nowhere. They go up and down, up and down. They end up in the same place every week. But Shiba Inu, the meme coin, has gone down, dropped down from number 14 to 15. It has been as high as number 10 in the cryptocurrency market, but it's been taking a beating. That's it on the cryptocurrency market. So, dope. Let's talk about cash is king.
Yeah, and again, you did reference it by saying cash is king. A lot of people think that, and that's what you got to remember. And when we talk about cash, we aren't just talking about dollar bills. You know, we call it cash equivalents. Okay, and just make sure you understand. So we talk about cash equivalents. That could be savings accounts, it could be checking accounts, money market, mutual funds, EFT mutual funds, it could be certificates of deposit, CDs that you have in the bank. It could be short-term treasury debt, okay, I-bond, for example. And as it's a super safe alternative to equity. Definitely super, super safe. And they are positioned to get higher yields, you know, from higher interest rates. And right now, interest rates are going up, and you're starting to see that trickle in to the cash equivalent market. And it may sound reassuring, and people are getting excited. Oh, I'm getting 5% on my CDs, and oh, life is good. But remember, you know, inflation is much higher than that. So you really aren't staying even. And so it sounds like it's a reassuring place to put your money during a recession, but maybe it is, maybe it ain't, and that's what we're going to get into tonight. And it seems safer right now than being in stocks and bonds, which are they got killed in 2022 and starting off this year. But we're going to really focus on, is cash king, and is that where you should put your money right now?
Yeah, because believe it or not, you know, it does have its place. Cash and cash equivalents, it does have its place in your portfolio because the high yield online savings accounts are averaging about 3.3% annual percentage rate, up from less than 0.5%. That was half of 1% a year earlier. That's according to the depositcounts.com. Now, 1 year ago, online CD was averaging 4.4 annual percent rate, up from nearly 0.6% So the average 7-day yield for the 100 biggest money market funds stands at 4.34%. That's for money market funds. Money market funds are like mutual funds that are invested in short-term securities like treasury bills and commercial notes. And it hasn't been that high in more than a decade. So that's just lets you know about that. And with maturities under a year, treasury bills are fetching yields at above 4.5%. And they were all the way down to 2% over a year ago. Now, but consider these returns compared to performance on the stock market. Now, even with January's start, the Dow Jones Industrial is down more than 4% over a year. And at the same time, the Standard & Poor's is off 9%. And the NASDAQ, which is most of the big tech companies, they lost nearly 17%. Now, financial advisors, had surprise about how much idle cash from clients was waiting for, on the sideline to be invested. Now, lowering stocks and bonds allocations might be an idea in your portfolio, but you got to really be careful because putting, the extra money in short-term CDs and bills and treasury bills, I don't know if the stock market start going back up and you're locked into some of these low interest like CDs or treasury bonds, you might really need to consider and have a plan on what to do with your cash. Now, cash is king right now. Cash is the cool kid on the block right now. Don't get me wrong. But remember, the market has its turns and its ups and its downs, and you need to plan accordingly to your financial goals, not to what the market is doing, but what you're trying to do and with the money that you have. And with that, Dope, let's talk a little bit more about the strategies of being in cash.
Yeah, and when you look at returns of cash compared to the stock market, it looks pretty good, especially now when you look year over year. Bob just told you those numbers. The Dow is down 4% year over year. S&P 500 is off 9%, and Nasdaq is down 17%. So now everybody's interested in cash and how much money can I make in cash. And whenever they see the market go a little crazy, they'll let's go to cash. Well, it's not always the way to do it. And we've talked about this before it's one of Warren Buffett's major principles is to buy when everybody else is selling and to sell when everybody else is buying. And that's what we see happening here. A lot of people are starting to panic and starting to sell and say, oh, I'm going to get in cash and get that 5%. And we've talked over and over about how difficult it is to time the market and how after every recession, there's always a large increase in how the stock market is making. And so one of the biggest mistakes you're seeing investors make right now is shifting out of stocks that have already taken a big loss and probably won't go down a whole lot more. But they're doing that same thing I always talked about, selling when the market is down. So they're selling at lows, and then they're putting their money into these higher yield savings accounts or CDs or money markets or whatever. And so you should really just take advantage of those higher interest rates on your rainy day funds, your rainy day funds, your emergency funds, your large upcoming expenses, and if it's a small part of an investment portfolio. But that shouldn't be a major part of your portfolio. You shouldn't be jumping out of stocks, getting into cash at this point, because if you've done as we've advised or as we've recommended, you have assessed your risk and you know how much money you should have in stock, how much you should have in the market, and how much you should have in cash. You've already done that. So if you're selling when everything is low, you're going to be way overloaded in cash. You're going to be underrepresented in stocks. And when the market does recover, you miss that ride. And every big recession we've had in this country, the market has done very, very well a year or two after that. And nobody knows when it's going to stop. Nobody knows when things are going to start going up. So there's no reason for you to try to figure out when to get back in. You don't sell when the market's low. Now, some people could say, well, the market may go down even more. Well, it may, but you should have already assessed your risk level, and you should be uncomfortable. Nobody says anybody's doing cartwheels because the stock market's going down, but it's the long play that you're after. And if you're doing things like dollar cost averaging, you're buying more shares while the prices are low. And that's the benefit of dollar cost averaging and consistently being in the stock market.
So with that, it's important to have a CMP. That's called a cash management plan. And part of the financial investment, it should be part of your financial investment plan. You don't want too little, but you definitely don't want too much either. Now, it's common to hear experts describe cash investments as a big basket of choices where there's trade-offs between returns and liquidity. I just want to bring up this one chart. Well, we got a couple of charts for you, but I want to discuss, once again, we've talked about this before, but just want to talk about the risk reward with, the CDs, savings accounts, and money markets. If you look at the far left of the chart, they are the lowest risk because why? They got lower returns. And growth funds, mutual funds are sort of like in the middle. And higher risk funds like international funds and aggressive growth funds and individual stocks are considered on the high end. So as we always say, you must consider the risks that you're going to take. Because if a lot of people I know don't, in the thrift savings plan, the government 401k plan, they stayed safe because they, was nervous about, planning and then trying to, be into the market. And they stayed in the G fund, which is the lowest risk fund, which is in, government securities. And they missed out. In the last 10 years, the stock market was going up, 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 averaging about 15%. Some people got as much as 20, 25% in the last 10 years before 2023, right? No, before 2022, excuse me. And so, can't miss what you never have, but you want to have a cash management plan. And that's why we're talking today about there is a place for, low interest rate savings accounts and treasuries and CDs. There is a place for that. But like everything, you should really have a balanced portfolio.
Yeah. And but are we going to show okay, this is the one I was looking for. Yeah. And this chart will show you if you had taken $10,000 and you have three options. You can actually you have four. You can put it in stocks, you can put it in bonds, you can put it in 6-month CDs, or you can put it in 3-month T-bills. And so this is for this 20-year period that just ended December 2015. And what it shows you is what that $10,000 will grow to under each scenario. So if you have your money in 3-month T-bills, it's going to grow from 10,000 to 16,404. If you have it in 6-month CDs, it grows to 15,000 or 18,000 to 11. If you have it in bonds, it grows to 28,287. If you had it in stock in that 20-year period, you'd have $48,250. Now, the people who had their money in the 3-month T-bills and the 6-month CDs, they had no worries at all. You can see how the stock market kind of went up and down and up and down. But over the long haul, over that 20-year period, you ended up with almost 5 times as much as you started with. And that's what we keep insisting is the way to look at it. You look at how it will do over the long haul. The CDs and the T-bills, they are very safe. They allow you to sleep well at night, very little risk, but also very little reward. And don't know what inflation was over that period. So your real net earnings are probably even less than that. Same with stocks, so inflation would also affect that number also. But it's just such a tremendous difference between the investments in the different forms of investing. And nobody would be 100% in stocks. So maybe you do have some money in T-bills, some money in bonds, some money in stocks, and your actual return would be closer to 40,000. But that's still 4 times what you started with. And it's this is pretty clear cut of why we always recommend having some money invested in the stock market.
Now, let me make this perfectly clear, because we're not just telling everybody just dump your money in the stock market. We're always talking about have a plan and have a balanced portfolio. But this is the issue, you all, especially with our folks who are on here that are like 60 years old and older, who think, they want to be in the safe position, which is cool because it's all about your risk tolerance. But the actuary tables are showing that we're living longer. They used to be planning for people's retirement dollars around the end around 70 because the lifespan for men was 68. Well, now it's up to like about 82 for men and 86 for women. Some of them have 86 for men and 88 for women. So you're living longer. And the reason why we're telling you need to think your investment strategy, because you're going to be living longer and you want to have your money to have the borrowing power, because your money does lose purchasing power. As long as when inflation goes up, that affects the purchasing power of your money. Like I always said, if you took $1 and put it in your mattress, and a pack of gum last year was $1, and this year a pack of gum is $1.50, and you wanted to go get it, and all you had $1 that didn't grow, didn't earn, guess what? You're not getting no gum. So that's why we talk about still, investing, and you got to know your risk tolerance. Don't get me wrong, but we're getting older, and we're living longer, and some people say, "Well, when I get to 70, I'm not going to need that much anyway," and that's cool too. But if you got kids or if you got charities you want to invest in, you want to help, consider that. But go ahead, don't talk about places to park your cash.
Well, and the first and the most common is checking accounts and savings accounts. You just got to it's like we always talk about. You got to read the fine print and understand the details and know what you're getting into, because some checking accounts have more interest than conventional checking accounts. And many high yield checking accounts might require a minimum number of transactions before you get that higher, interest amount. And sometimes there's cash limits on if you have $10,000 or if you have $25,000 in, you get the higher interest amount. So if you want to put money in above these caps, you won't always get the same amount of interest as a high yield savings account. And so in many cases, the advantages of high yield checking over high yield savings might not be worth the effort. And so you really got to look at the detail and make sure you're getting an advantage between that checking account and that saving account. And we always, especially when you're looking at brick and mortar banks, they don't pay very well. Okay, it's as simple as that. If you look at some of the online banks, they pay a much higher interest rate than the brick and mortar. And the brick and mortar continue to operate and be in business because people continue to use them because they perceive them as being safer. And really the safety comes down to whether or not it's FDIC insured. And just make sure you do have that, whether it's an internet bank, a brick and mortar, a credit union, wherever else you park your money. And so a lot of times these internet banks don't have the brick and mortar, so they don't have the overhead costs associated with brick and mortar. So they are able to pay. I've seen online banks offering up to 4.2 interest on some savings accounts as they try to get ahead and look for an edge. So find you a checking account that's paying you a good interest rate, and if you're okay, you feel safe enough, you consider an internet bank. There's a lot of ways to go out and find one that's reputable, that has FDIC insurance, that is paying a very competitive interest rate. Just make sure you read the fine print and know what you have to do to get that high interest rate.
And so you see there, Maddie Ford. What's up, Maddie? Maddie said, would you suggest a 10-year to 15-year plan for 60 to 88-year-old people rather than a 20-year plan?
Okay, say that again.
Would you suggest a 10 to 15-year plan for a 60 to 80-year-old people rather than a 20-year plan? I guess, Maddie, I guess what she's getting at, if you are older, like say 60, do you really want to be planning out for 20 years, or should you be planning out 10 to 15 years?
And that's a tough one, and nobody has the answer to that. And the best you can do is estimate it, to look at your family history, you know how healthy you are, you know how well you take care of yourself, and all that could be positive, and you could go get hit by a bus tomorrow. So, I mean, nobody really knows. But if you're fairly healthy and you got good genes from your folks, then you might want to plan on looking at the average life expectancy for a black female, white female, whatever the case may be, and go based on that. And that's what my buddy said. He didn't want to be the richest person in the graveyard, and that's kind of the tack I'm taking. I don't want to leave too much money, but I do want to have money if I do live to be 90. My mother's going to celebrate her 103rd birthday next month, so I think I got genes on my side. I just need to give up some of the hamburgers I usually eat. But I'm planning on being here, and I'm handling my money accordingly. That's a tough call, though. You really got to look at a lot of things to kind of take your best guess of how long you expect to be around.
And I see where Maddie's getting at too, because remember I was saying that people were planning too short, like at 70, and not planning out further. Her thing was, what if you're older? Do you don't want to be planning too far out, like a 30-year plan? So I got what you're saying, man. That's the other way. You don't want to plan too far out there because, like you said, don't say it. You don't want to be the richest man in the graveyard.
Yeah, and it's kind of funny too, because I think we had a discussion when I talked about when to take my Social Security. I took it at my full retirement age, 66 years old. And my thinking was, because my break even was somewhere around 79 or 80. And all that says is, if I live past 79 or 80, I should have waited till 70 to take my money, as opposed to taking it out at 66. But my thinking was, I'm going to spend a lot more money between now and 79 than I'm going to spend if I live to be, let's say, 90, than I'm going to spend between 79 and 90. I just don't think I'll be doing that much between 80 and 90 as I'd like to do now. So I'd rather have the money now. So I guess I say all that to say, I hope I'm here till 90, but I can't imagine I'm going to be crazy active between 80 and 90 if I am here.
Yeah, you won't be putting on that Batman suit jumping off the dresser anymore. So I had the different strategy, right? My strategy, I took it early at 62, only because, I looked at it, the break-even point, like you said, for me was around 70, 72, but people forget from 62 to 10 years, I would be getting that money, and I figure I would be using it. So I didn't want to wait until then. And plus, I had a daughter in a major university, and I could use that money. Now, in hindsight, when I look back, and now, I turned 65, I look back like, God, I probably could have waited a couple of years. But no, I would do it the same. But that was my thinking. I was like, I'd rather take the money now, and between the 60 and 70, I'm going to use it. And I was investing it. So that was my strategy, though. So I'm glad we got to discuss that, because it's no right or wrong. It's just what works for you.
Good point, Bob. There is no right or wrong answer. You figure out your own situation, make a decision, and move on.
So I want to talk about money market funds, because a lot of people hear about money market funds, and they occupy the middle ground as far as when it comes to the cash investments, cash equivalents. Yields can run higher than savings account, though it usually takes a day to redeem your holdings, right? Now, these mutual funds, they're like mutual funds, are comprised of ingredients like, which I told you before, short-term, high-quality federal government and municipal debt, along with high-grade corporate debt that quickly comes due. Now, by the end of last year, money market funds had $5.2 trillion in assets under management. I guess because the market was where it was going, people was fleeing once again to cash equivalents. And that's well beyond the funds of $4 trillion in assets that was under management in 2020, the data shows. Now, it will be a couple of weeks before the latest 25 basis point hike, which was just enacted last week, will fully reflect the average yields. It usually take a couple of weeks for to see what Treasury did by raising the interest rates by a quarter basis point again. But the last time the biggest money market funds average 7-day yields surpassed 4% was December 2007. So that shows you where the interest rates are going on these cash equivalents. Now, the biggest, weakness is now their greatest strength, they say. That as the spread in these yields for many savings account money market funds widen, consumers will do well to pay more attention to these vehicles. That's what some investment managers say. Now, the ultra short term, what they call electronic exchange traded funds, are another options. And like money market funds, they give exposure to government and high quality corporate debt that matures quickly. And the corporate debt bonds are a little bit more riskier, obviously, than government bonds, which is backed by the full faith and credit of the United States government.
Okay. Next, we're going to talk about CDs and T-bills. Okay.
Yeah.
Okay. And they lie on the other side, cash spectrum. Their maturity terms are usually between 4 and 52 weeks, even though you can get them for 2 years, 3 years, or whatever. And yields may be higher than money market funds, but you're usually locked in for a certain period of time. And oftentimes there's a penalty if you want to pull the money out prior to its maturity. And so right now, the market yield on a 1-month T-bill is about 4.6%. And it hasn't been that high since 2007, which is just crazy. And you can buy Treasury debt, you can buy through your broker, or you can go right to treasurydirect.gov. And that's also where you buy I-bonds. And I got to tell you, that site is kind of awkward to use. But I mean, I bought some I-bonds on there, and it's you can get through it, but it's not easy. It's the government. And one big advantage of buying T-bills is that you don't have to pay state income tax. You do have to pay federal income tax, but you don't have to pay state and local taxes. And so when you're comparing rates and you're comparing it to money markets, make sure you take into account that you don't have to pay taxes on the state. And if you're from someplace like New York, New Jersey, or even down here in South Carolina, where the marginal rate is 7%, that's a nice little savings if you do have a T-bill. And so the secondary market for T-bills is a lot larger than it is for CDs, and that makes an early exit easier, but there still may be a penalty involved. And so if you can buy CDs with longer maturities, and you might feel you're tied up because rates may come down, and then you kind of above the game if rates come down. But if you look right now, everything's kind of looking like rates are going to continue to go up. And obviously, especially after today's market activity, you kind of get the impression that it's going to be up longer than it's going to be shorter. And so if you got money in T-bills or CDs, and then the market takes off, you kind of get that feeling that, oh man, I'm gonna be left behind. So, but that's the price you pay for having a little higher interest rate. You have to take that longer term. So You have to really take your time and look at how long you're tying your money up for. What are the ramifications if you decide to pull that money out early? What are the penalties involved? And it's just like everything else. You got to sit down and figure out what's best for your own situation. There is no one size fit all. You know, and some of your cash, you might be better off putting it in a 1-year T-bill or 1-year CD. In other situations, you might only want to go 6 months. And so anything you do in CDs or elsewhere shouldn't cloud your overall goal of what you're trying to accomplish. You know, cash is for yield and stability. It should be the safest part of your portfolio, even though we don't believe it should be the biggest part of your portfolio.
Yeah, that's something to really think about. But it's places that you can park your money, that's for sure. Hey, Doe, you know what's so interesting? In America, it seems illegal for you to rob a bank, but not the other way around.
That's for sure. That is the truth.
Because I'm telling you, you know, especially before the rate started going up, when they were giving less than 1% on your savings account, so you were basically paying mugs, you know, to hold your money, and they using your money. But that's not here nor there. I'm just trying to be funny. But as a result, you need to shop around and get the best deals. Now you can already get 5% on a 1-year CD in a couple of places. You just go online and can shop that. But remember, it has to be, not doesn't have to be. It is best that it has the FDIC symbol that is insured by the FDIC. That way, if the bank bellies up or becomes insolvent, you'll be protected and get your money because you know it's up to $250,000 insured per category of accounts. Now, you should expect more of these CDs, and they're going to be getting better as the market adjusts to the latest economic news. You know, but don't get overzealous. But think about your time horizon. You know, we always talk about when you're planning, you got to think about your risk, but also think about your time horizon. Because if you're going to need some money you need the money in the next 1 to 3 years, you might consider keeping it into, you know, cash equivalents. But past that, you know, you might look at it, putting it in for the long play. Now, retirees and other lower risk savers have suffered for years from minuscule savings. Like I told you, that many of my friends, they kept a majority of their thrift saving plan funds in the G fund, you know, and they missed out, you know, on the rates, especially after the global financial crisis in 2008 when the market came back it came back 100%. Now, the Federal Reserve and other central banks has slashed rates to zero and kept them there as long as it possible back then. And they did it during the COVID and the lockdowns. But now the higher CD rates are going to be going up. And naturally, we don't know for sure, you know, where they're going to end, but just make sure you have an investment strategy. Now, according to the basic economics, when the Fed rates interest rates, banks and credit unions, you know, start, passing these higher interest rates and through the higher interest on savings accounts and certificates of deposits. But it isn't quite that simple. And it's not just because banks want to pay you as little interest as they can get away with. Okay. Now, the interest rates on CDs and other products will depend on where the market expects short-term rates to head after they rise. Now, even now, after the latest inflation surprise, because it came down, inflation came down last month, you all, but yet the market is still taking the beating, and it's pretty interesting because what the Federal Reserve has been doing, they're saying is working because it's lowering inflation. And Wall Street suspects that rates will peak in the fall and may even start coming down around Christmas. Now, latest monthly inflation data works out to around about 6%. It was up as high as 9%. So it's down, and that's good. Now, the markets and the Fed are still betting aggressively that it's going to keep coming down. But unless it does, someone buying a 1-year CD paying 5% interest or even more is basically going backwards on the real purchasing power of your money Because if the market starts going up and you locked in at 5% and you can get 10 and 15%, you kind of be going backwards. But this is once again is based on your investment strategy. And the best thing is to look at the best deals out there, search for them and take time to shop around.
Okay, about one more thing I wanted to mention, because a lot of people, when they see the market go down like this, that they stand up and they say, look how much money you've lost with the big market pullback. But the thing they miss, like if you look back 5 years for the S&P, and you say, okay, what has the S&P done over the last 5 years? Well, it's actually up about 49% over the last 5 years. So at one point, it was up almost 60%. But with this fallback, it's down to now it's only up 49%. So even though the market has had a big fallback, had you been in cash, you still would be way worse off than you were in stocks. So you're still up 49%, even though the market has had a big pullback. And so people say, look how much money you lost. Well, if you just look at the stock situation, you still have way more money than you would have had you been in cash or cash equivalent. So you lost a lot with this pullback, but you had something to lose because you were up almost 60% at that point. So now you're only up 49%, but you're still up 49%. And had you been in cash equivalent, you would probably still be up only 1 or 2 or 3%. So it's the argument for continuously being invested at some point up to your risk level in stocks.
That's a very good point to make, Tote. Very good point, and you need to be conscious of that. So,
you're going to show that chart, how the market's done after big hits in the recession. I mean, big bad situations happen, and what the market's done afterwards.
Yeah, no, I don't have that. I don't have that chart tonight, there, bro.
Oh, no big deal. But just to make that point, after every recession, the market has done tremendously well right after that. So just keep that in mind. Hang tough. Try not to sell. Don't sell when your stocks are low, and then buy when the stocks are high. So
now let's summarize what we talked about with the cash is king topic, though.
Okay. And first of all, there's always a place for cash in your portfolio. Again, we talked about those 4 uses: for your daily spending, for your emergency fund, for big purchases. And what was the 4th? Emergency fund, big purchases.
Spending.
Spending. That's the 4th one. Exactly. So, I mean, there's a place for it, and just come up with your own comfort level of how big a part of your portfolio it should be. But you will not build wealth getting cash and cash equivalent interest rates.
Yeah, thank you for that lead-in, though. So cash and cash equivalent are not optimal for building wealth. You can. It's very hard to build wealth being in a savings account, and especially in a checking account. Your money has to be growing, and compound interest is the best things to the 8th wonder of the world, 7th wonder of the world, however they say it. So, and I know we're just giving you suggestions, and I know we're pro stock market, and the only reason why we're pro stock market because both of us have benefited from it. But it's all about your risk tolerance. If you got a low risk tolerance, you get what you get. But it's hard to build wealth in a savings account.
Yeah, traditional banks pay below market interest rates. And when we talk about traditional banks, we're talking about brick and mortar banks. There are other options out there that are FDIC insured that pay much higher interest rates. Remember what Bob said earlier. You'll go to jail for robbing a bank. Nothing happens when banks rob you, and that's what they do with the interest rates they pay.
And shop around. If you're gonna look at these cash and cash equivalents, like I said, savings accounts, CDs, money market, T-bills, and stuff like that, and um, corporate debt. Just make sure you understand the terms. How long they're going to lock you in. It's a penalty for you getting out of them. If you need the money, you need to look at that. Need to see, does it meet your needs, and you need to understand what you're getting into. So like all investments, we say we don't care if it's gold, if it's commodities, if it's tech stocks or financial stocks, you all cryptocurrency. You must understand what you're getting into, even if it's low risk cash equivalents. So don't let that just think that you're just safe and you can just put your money in anything. Like I said, if you're going to put it in there on online, make sure it's insured by the FDIC. Know what you're getting into, understand the terms. I mean, we can't say that enough.
And Bob, I think this should be a takeaway for every show we have. It takes work to build wealth. It takes time. It takes effort. It takes learning something new. Sometimes it takes doing things you aren't uncomfortable with. But building wealth isn't easy. I tell you what. But once you do, it sure is fun. It's fun having wealth. I can tell you that.
It sure enough beats the alternatives.
Yeah.
Money isn't everything, but it takes the pressure off. Once again, though, great show. I want to thank everybody for tuning in. Maddie said, Bob, I was told by Examiner that the banks had to make their money, so why not make it off of people? Yeah, that is kind of messed up, though, Maddie, right? But like Jesse James said, why did he rob banks? He said, because that's where the money was. So, as always, shout out to Garnett. Thank you, Garnett. You're the first one to in, always. My sister Linda and my wonderful sister Gloria. Hello and welcome. Thank you for being out there. Hey, now, what's up? Now, thank you as always, dearest, for tuning in. Maddie Ford, thanks for the comments. Hey, Dope, Modestine was talking about she can't withdraw her Social Security because she makes too much money.
Now, well, they withhold some if you pull it out before you hit your full retirement age. So
yeah, that's what they
don't want to do it if you're still working.
Yeah, that's what they hit Modestine with. She's like, but Modestine, that's a good problem to have, baby.
And let me give the other side. If you wait to pull your Social Security out, the amount you pull out grows by 8% every year. So there's nothing wrong if you are able to wait until you're 70, because I mean, you got 8% guaranteed is going to go up every year. Okay, let me make sure I make that clear. If you pull it out at 66, and let's say you get $100 at 66, if you wait a year till 67, you'll get $108. And if you wait till 68, you'll get 8% more than 108. And so just be aware, there's nothing wrong with waiting. There's no harm in waiting, because the amount you get grows by 8% every year. It's hard to make 8% on your money. So if you don't need the money, then obviously it's better to wait. But I chose not to.
That's so interesting, that statement. If you don't need the money, boy, you sound like a daggone Warren Buffett. Who don't need money? Stop that daggone foolishness. But hey, what's up, Carl? My brother Chapman. What's up, homie? Hey, Joanne Skinner. Thank you, Joanne. And look, Rodney Madison Sr., we're going to have Rodney Madison on to talk about mortgage notes, holding mortgage notes. Plus, Rodney also knows about self-directed IRAs, which he's using that to fund the mortgage note. So go out there, check him out, Rodney Madison Sr., thenoteexperience.com. And we're going to have him to talk about as another vehicle, investment vehicle, especially that self-directed IRA. It's so interesting when people are doing that with real estate, though, and saving them so much in taxes. Maddie Ford, as always, love you, darling. Miss you much. And we hope to see you next week. Same bat channel, 8 p.m., the FITT Show. Next week will be the 23rd. So look forward to seeing you there. 8 p.m. Make sure you share this. Please go out there and share this information because we're not just trying to hoard this information. Our people definitely need more information because information is power. Dope. Any closing remarks, bro?
Not one.
Well, thank you all, and we look forward to seeing you next week.